Picture a telehealth titan that rocketed to $72 and in just a matter of few weeks plummeted 60% to 27 and still has analysts eyeing a $45 target by end of this year. That's HIMS and HERS, the most polarizing stock of 2025. Is this dip a golden opportunity or a warning sign? Stick around for fresh news, insider trading secrets, and what's coming in their May 5th earnings. And I do need your take in the comments. Welcome back to the channel where we dissect the stock shape in your portfolio. This is my third deep dive into HIMS and HERS, ticker symbol HIMS, and it's mainly due to the fact that it's kind of a stock with wild swings and huge growth potential, which keeps us glued to this potential 10 or even maybe 20 bagger in few years time. As a leader in the telehealth market for men's and women's wellness, weight loss, HIMS is the market's darling, but not without risk. The stock is probably battered by macrofells like tariffs and Fed Chair Jerome Powell's inflation warnings and comments. But here's the twist. HIMS has also previously in 2022 plummeted like 80 or 70%, also in 2020. And it still kind of came back up in those years. So the question is another kind of comeback brewing here? So last year HIMS' weight loss strategy was in the spotlight. They have been a powerhouse in the compounded semaglutide, but with shortages easing, FDA is tightening the screws, which means that they cannot sell the compounded drugs much as easily as before. HIMS is starting to pivot to branded drugs like Eli Lilly's Zepbound at $18.99 a month and generic liraglutide. This kind of triggered a 9% stock drop on March 18th after FDA's warnings, but as soon as Zepbound from Eli Lilly's was launched, there was a surge in the stock price around 10 to 12%. The problem, well, the branded drugs should mean slimmer margins, right? And I believe that's one of the reasons why some of the analysts are a little bit negative in this past few couple of months. Now, before we go into the fundamentals, let's have a look at the insider trading. And to be honest with you, there has been a lot of sales over the past couple of months, especially in the peak of the stock when it was like, 48, 50, 60, and even 70. People like the CEO, Andrew Dodum, and people in the chair like Melissa Baird sold like stocks for millions of US dollars. I believe a couple of them even sold for tens of millions. So in a small company, you might as an investor starting to question this thing, but I would say that these are pre-planned under Rule 10b-51 of SEC. So they're not panic sales, I wouldn't say, but the volume is turning some heads, I would say. So you still should keep your eyes on this. So now going to the fundamentals, we can see that the subscriber growth is continuing to go up. I mean, they had like 500,000 subscribers in 2021 and now they're at 2.2, and I'm projecting them to have essentially 3 million at some point this year or very early next year. So we can see that their revenue increased 70% year on year from 2023 to 2024. And they gave a guidance of 2.3 to 2.4 billion for 2025, which would represent a healthy 55 to 65%. Subscribers, as I mentioned, quadrupled from 500,000 in 2021 to 2.2 million in 2024. With the average revenue per customer rising from $51 to 64. And over 2/3 of the sales comes from non-weight loss segments like dermatology, mental health, sexual health, each projected to exceed 100 million in 2025. That's, in my opinion, a diversified portfolio and a diversified powerhouse that seems to be able to grow at insane growth rates. You could argue that the profitability is very solid at 8.2% net margin in Q4 of 2024 and a 12% adjusted EBITDA margin. They have essentially zero debt. And the valuation at 6.3 billion market cap, it gives them a kind of trailing PE of roughly 60, but the forward PE drops to like 37, 38 based on estimates of 2025 EPS of $0.72. This gives us a PEG ratio of 0.6, which screams, in my opinion, undervaluation. Remember that there's also some turbulence, like Q4 gross margin slipped a little bit due to rising cost and the FDA shortages about the weight loss drugs that they compounded in-house is now a little bit more difficult to sell. So they have to go to the, those original drugs from the likes of Eli Lilly, which probably again will reduce their margins. So the question is this a growth rocket or a margin wobble? I don't know. I would like to see your comments on this. So on May 5th, we're going to have their Q1 earnings, and it could be a catalyst, in my opinion, Analysts expect revenue of 500 and let's say 40 million, which is close to my own 542 million, up 87 to 94% from the 278 million a year ago. And EPS could be 14 cents, nearly triple Q1 of 2024's 5 cents. There's also some interesting data points, like Bloomberg's second measure data shows that Q1 sales soared 119% year over year, smashing the 92% growth Wall Street forecasted. And the key focus areas, well, the weight loss segment, how Zepbound's faring post-semaglutide, subscriber growth, and that 85% retention rate could also be interesting. How is the margin gonna look like after the Q4 dip? And 2025 continuous guidance, will they stick to 2.3 to 2.4 billion? Are there increased risk? Have they potentially raised any concern about the missing EPS like they did by a single penny last quarter? And any other macro pressures like tariffs that could affect their business. So I mentioned to you that the analysts expect a 14 cents earnings per share. And if we go through my own estimations, we can start again with the revenue 542. I believe they're gonna become more linear, maybe gross margin go back up a little bit at the end of this year, but this first quarter I'm expecting a little bit drop down again, but still very healthy 75% almost. I would expect the marketing to go up quite a bit, but the total operating expenditure should not increase more than 10%, which is good because that's actually increasing, in my opinion, at a slower pace than the revenue. And that's going to be really interesting in the graphs that I will show you later. I do believe that HIMS probably going to do a 25 million or so net income, which would represent earnings per share at around 10 to 11 cents, slightly lower than the estimates, but I would say like let's be conservative, let's do not become super optimistic about everything. I mean, if this come a little bit higher at 14-15 cents, I would be very, very happy. Wouldn't definitely be surprised, but I'm going with 10 to 11 cents. Other interesting metrics in my opinion is stock-based compensation, sitting at a healthy 5 to 4.5%, which seems to be going down over the past 10 quarters or so. That usually it was 7 to 8%. We're now down to the low 5s, potentially going even lower. Then when it comes to net income in relation to the revenue, it's still in very lows, like 4 to 5%. But I do believe we are going in the right direction. And interestingly, the adjusted EBITDA compared to revenue is going to be slightly, in my opinion, lower than Q4, but still going to be on a longer term trending upwards. Now, the interesting parts for me with HIMS starts actually when you look at these other metrics here, like marketing. Remember that marketing is a huge post for HIMS and hers. If we go to the operating expenses, the total operating expenses is roughly 350 million in the last quarter, which was the Q4 of last year, of which 221 million was marketing. I do believe as HIMS grows, as the name recognition increases, as you can see on the Google Trends, if you look at the Google Trends for HIMS, you can see that over the past 5 years, it's been going up. There's always peaks. I mean, obviously, there was this huge peak in January and February due to the increase of stock price, right? The stock price increased from like low 20s and low 30s to like 72 in just few weeks. Of course, it's gonna look like this. But if you look at the trend over the past few years, this is a company growing in popularity. So I do believe that naturally the likes, like we've seen Netflix previously 10 years ago, 15 years ago, the name recognition is gonna be a huge thing. And I think the marketing post, which is a huge part of HIMS. I mean, look at this, like net income net income in the last quarter was 26 million. They could easily, with some nice name recognition, cut down on the marketing cost, right? They could easily go to 190. That would more than double their net income, right? So the earnings per share in the last quarter, if they just reduce their marketing expenses, could be already 20-25 cents, which means that there's a false negative view of HIMS when you see that how much they actually put in marketing. And I think these graphs show it maybe slightly better, going to the marketing divided by revenue. So you can see here Q1 of 2023 to the left, and then you have all the way to Q4 of 2025, which are estimates. Then you can see that the total operating expenditure in the gray bars, the marketing divided by revenue, is slowly but surely trending downwards. Like it has been around 50% in 2023, but now we are, probably closer to 42, 43%. So that's gonna be a long-term trend, 45% according to last quarter, 45.95. Then operations and support divided by revenue also going down slowly but surely. Essentially what they are doing, like they're gaining some momentum due to the scale of the business and the name recognition. So I'm quite positive about HIMS and others. I understand that it's been a hectic time, the stock price has been going down, and I started to cover it. I've been following the stock for a year now, essentially, maybe a year and a half. But I started to cover it on my YouTube channel over the past couple of months because I felt like there was too much hype in this period in February. So I started to do my first videos just after this drop here. I think maybe around 38, 35 US dollar stock price maybe when I did my first video. But I do believe that if nothing drastic happens, you have to continue this stock on week by week basis. There's so much volatility. I believe they have like 87 days over the past couple of years where they traded either 5% up or 5% down on a single day. So this is a very volatile stock, but this is kind of normal with a high growth rate companies. I wouldn't be surprised by 2028 they would have like a close to 10 million subscriber base, and by latest 2030 that's gonna be a company that's gonna make a couple of billions of revenue every single quarter, right? And with the scaling and everything that they can do, I haven't modeled all the way to 2030, but I wouldn't be surprised that they would make a couple of billion a single quarter. And in that scenario, with the scale that they have and the name recognition that they have, with the cut down on the marketing expense, I wouldn't be surprised if they get if they double their adjusted EBITDA compared to their revenue, which means that if we assume a 25% adjusted EBITDA by end of 2030 on a 2 billion or per quarter revenue, that's 500 million of adjusted EBITDA per single quarter for a company that you can buy right now for 6 billion total market cap. And that 500 million adjusted EBITDA was on a single quarter, right? It could be a couple of billion of adjusted EBITDA by end of 2030. I think this is a very nice risk reward ratio here on this company. I think at below 30 US dollar, I would be very happy to have this stock in my portfolio. This is not investment advice. I think there are huge risks. There's huge volatility. There's a lot of discussion about competition out there, and you have to do your due diligence. And with these kind of high growth rate companies, you have to follow it week in, week out, which is something that I'm aiming to do now. But yeah, so this is probably gonna do it for today. I think there's been a lot of insider sales for sure over the past couple of let's say couple of months. But I mean, who wouldn't? I don't blame the management team to sell the stock when it skyrockets 300% in 6 months, right? It's nothing unusual. Every single management team takes profits down the road. That's just normal. What I don't want to see, stock-based compensation goes up. But over the past, from looking at Q1 of 2023 to Q4 of 2025, obviously these last 4 quarters would be estimations, but still, even Q4 of 2024, we're down to 5% from 7.5%. So they cut down stock-based compensation as related to the total revenue of the company from 7.5% to essentially 5% in less than 2 years. So I'm quite happy with that as well. So I don't think this is an extremely greedy management base. I think I've seen worse, like Palantir, much more stock-based compensation. Things are looking, yeah, I think this price, at this kind of price, I'm really interested in this stock. But anyways, it's gonna do it for today. Please like, subscribe, and comment in the comment section, and see you in the next one.